U.S. retail sales declined more than expected in January, as we've been discussing here this morning, posting steepest decline since March of last year. The drop in retail sales raising questions of whether Americans' resilient consumer may be losing steam. Joining us now to discuss this and much more, we've got Michelle Meyer, who is the Mastercard Economics Institute Chief U.S. Economist. Michelle, always a pleasure to get some of your time as well here. So walk us through how you're evaluating this resiliency of the consumer from the Mastercard perspective, and where we can expect that to continue. And with a reading like today, if it's just a blip as we've been trying to wrap our heads around, or if there's something under the water at play.
Sure. I think you have to look at the trend in consumer spending, not just 1 month of data. And the trend has been one where consumers are still very much out there spending. And remember, the January report is coming off of what ended up being a robust holiday shopping season, particularly at the very end of the calendar year, which showed consumers that, I think, resilient, yes, but empowered is potentially even a more descriptive word to explain how consumers are feeling right now, which is they have a lot of choices. They're choosing when they spend, how much they want to spend, what they want to spend on, because you have a more normal inventory environment and you're seeing big gyrations in terms of inflation rates by different categories.
And Michelle, where are you seeing most consumers determined not to pull back? Because we talked about sort of down trading and other things. Where are the stickier parts of this picture?
So probably the stickiest, or where consumers have been the most excited to spend, has been for these experiences, and particularly for things like concerts, sporting events. We recently did what we think is a pretty cool study on how Taylor Swift impacted the economy, and not just on the aggregate, which a lot of people talked about, but given our unique insights, we were able to look at how the concerts impacted the local economies by sector, by zip code. And we found in the areas, in the 20 cities that she toured in the US last year, spending on restaurants within a 2.5 mile radius of the stadium was up somewhere around 70%, with some markets up as high as 170% increase. So that shows a consumer that has had the ability to spend. They have been able, again, and willing to spend more for certain items. But it's that same consumer that will walk into a store and look for that promotion or be careful of how they deploy their money.
So how does that kind of impact the outlook for 2024, if you think about the experience economy, where spring break, where summer, where that's spending, especially facing some tough comps from 2023 and the year that was the Renaissance tour, the year that was the Eras tour, and of course all of us going to see Barbie and Oppenheimer, or whether or not we actually wanted to see Oppenheimer. At the end of the day, that was a lot of experiential spending that we did. How is it expected to comp up to that?
Well, I think you touched on something important, which is comps, right? It's a year-over-year change, and 2023 was defined as a big bounce off the bottom. So it's harder to bounce now. But from a level perspective, I do think you're going to continue to see some robust spending in those categories. It's probably going to be big picture, right? When you look at the basket of spend, though, it's going to be a bit of a convergence in spending versus 2023, where there was a very extreme bifurcation in the basket. And part of that is because of these price differentials. So when you look at the real consumer spending trajectory for the consumer, for certain things like housing related items or durable goods, where there's been a lot of price discounting, you might actually see real units increase. Whereas in those categories where prices are still very high, where you're seeing some stagflation, if consumers are not as willing to accept that, you could see some reduction in real spending for those categories.
So, Michelle, as we continue to see consumers, as you mentioned in this note here, balancing prices and priorities, how does this change then, as we perhaps will, at some point this year, later on in this year, see a Fed rate cut kick in?
Well, a Fed rate cut would be very helpful, of course, in terms of thinking about how much money they have to put towards debt service. So as the Fed starts to ease, cut interest rates, it's going to provide a support for those categories that are more interest rate sensitive. So even think about today, this morning, you've got retail sales, but we also got the home builder confidence survey, which picked up and has been rising now for the last several months, which shows that home builders are getting more confident about the fact that interest rates have come down. There's still a low level of supply of homes, and they, starting to plan for greater construction and upturn in that cycle. So an easing of monetary policy does provide support for the broader economy. And I would argue probably the most important factor to dictate how the consumer fares this year is really the health of the labor market, which is holding up really nicely.
Just lastly, while we've got you, Michelle, in travel spending, what are the anticipations that we're seeing as we kind of look out to the rest of this year?
Sure. So just like you've seen the consumer engage in terms of experiences broadly, whether that's Taylor Swift, Beyonce, et cetera, you are also seeing a consumer who's been really eager to travel. If you look at the last summer season, this last year's season, consumers really embraced traveling abroad. The dollar was strong, that facilitated that. And I think many of those dimensions are still in play, but you do have to consider this year-over-year comp. It's going to be harder to see these extraordinarily impressive year-over-year growth rates. So look at it both from a level and a growth rate to put that into perspective.
Now, of course, in terms of how people plan on paying for these experiences and everything else, continuing to see not just credit card debt, but also some of the defaults also starting to pick up there. How do you balance that when you're thinking about the strength of the consumer and how they're spending and funding their experiences?
Sure. So I think you want to look at the household balance sheet holistically, in the sense of how much debt is being taken on in the context of how much wealth has been created. And if you look at measures of net worth from the Federal Reserve, we're so close to, the highs that we've seen of this cycle and actually in recent history. So the household balance sheet is still healthy on aggregate, and that's really important to keep in mind. And overall income creation is still looking solid. So you have to consider all these different metrics rather than just necessarily pointing out one particular figure. And again, I think it goes back to the labor market. It's the flow of income that drives spending and drives debt service and all the other decisions that the consumer has to make right now.
Indeed, and with a low unemployment rate, that continues to be the case. I appreciate you taking the time to join us. Michelle Meyer, Mastercard Economics Institute Chief US Economist. Thank you so much.
Of course.